This is Saturday, February 1st, 2026. My name is William Lee, and I need to talk to you about what happened 2 days ago, because if you do not understand the real mechanics behind the crash on January 30th, you are going to get wiped out in the next wave. What you witnessed on Thursday was not a market correction. It was not normal volatility. It was not investors rationally reassessing valuations. What you witnessed was a coordinated expulsion, a deliberate and systematic effort to shake out every retail investor who had accumulated positions in gold and silver over the past several months. And if you fell for it, if you sold at the bottom in a panic, you did exactly what they wanted you to do. You handed your metal to the same institutions that crashed the price so they could buy it back cheaper. This is not conspiracy theory. This is how markets actually function when you understand the machinery underneath the surface. Let me paint the picture of what happened on January 30th, because the sequence of events reveals everything. Gold was trading near $5,600 per ounce. Silver was trading at $121 per ounce. Both metals had experienced extraordinary gains over the previous months. Retail investors around the world had been accumulating physical metal at record rates. The Perth Mint was already overwhelmed with orders before the crash. The US Mint was struggling to keep products in stock. Dealers across India were experiencing unprecedented demand. Regular people, not hedge funds, not institutions, but regular working people had finally woken up to the reality that the dollar is losing purchasing power every single day, and they were protecting themselves by buying real assets. And then in a matter of hours, gold crashed from $5,600 to $4,150. Silver crashed from $121 to $95. Trillions of dollars in paper value evaporated across gold, silver, stocks, and cryptocurrency simultaneously. The speed was breathtaking, the violence was unprecedented, and the timing was not accidental. Let me explain exactly why this happened, because the official explanations you are reading in financial media are mostly noise designed to distract you from the real story. The crash occurred because too many retail investors had accumulated long positions in precious metals. The trade had become crowded. Sentiment was extremely bullish. Everyone was talking about silver going to $150 and gold going to $6,000. Social media was filled with people celebrating their gains and encouraging others to buy. When a trade becomes this crowded, when sentiment becomes this one-sided, the market becomes vulnerable to a specific type of attack. The large institutions that control the paper markets can see exactly where all the retail positions are concentrated. They know where the stop losses are set. They know where the margin calls will trigger. They have access to order flow data that shows them precisely how much selling pressure will be unleashed if price drops below certain levels. And on January 30th, they used that information to engineer a cascade. Let me give you a simple example to understand this mechanism, because it is crucial that you grasp how this works. Imagine you are playing poker at a table where one player can see everyone else's cards. That player knows exactly what hands everyone is holding. They know who will fold if there is a big bet. They know who is bluffing. They know who is committed to their position. Now imagine that same player also has unlimited chips. They can make any bet they want, as large as they want, without worrying about their own risk. That is essentially the position that major institutions occupy in the precious metals market. They can see where retail positions are concentrated through order flow analysis. They have access to essentially unlimited capital to move prices. And they operate in a paper market where they can sell contracts for metal they do not actually possess. On January 30th, this is what happened. Concentrated selling pressure was applied during US market hours, not during Asian hours when physical demand is strongest, not during European hours when London trades, during US hours when COMEX is most active and paper trading dominates. The selling was not random. It was targeted. It was designed to break through key technical levels where retail traders had placed their stop losses. Once those stops were triggered, automated selling cascaded through the market. Each wave of selling triggered more stops at lower levels. Margin calls forced leveraged traders to liquidate their positions regardless of their desire to hold. The feedback loop accelerated until prices had crashed more than 20% in a matter of hours. But here is the part that reveals the true nature of what happened. While the paper price was crashing, physical metal became impossible to buy. The Perth Mint suspended sales. The US Mint suspended sales. The Royal Mint ran out of stock. Indian dealers defaulted on deliveries. Costco implemented purchase limits. If this were a genuine market crash driven by actual selling pressure from real holders of metal, you would expect the opposite to happen. In a real crash, supply increases, sellers come out, inventory piles up, prices drop because there are more sellers than buyers. But that is not what happened here. Prices dropped while supply vanished. The paper price said silver was worth $95, but you could not buy physical silver anywhere at any price. That divergence tells you everything you need to know about what actually happened. The paper market was used to manipulate prices lower so that institutions could cover their short positions and accumulate physical metal at artificially suppressed prices. Meanwhile, retail investors who panicked and sold their positions provided the exit liquidity that institutions needed. The wealth transfer was executed with surgical precision. Retail fear became institutional opportunity. Now, let me explain why this battle for positioning in gold and silver is so important right now, because there is a much larger story unfolding that most people do not understand. The dollar is losing purchasing power at an accelerating rate. This is not opinion. This is mathematical fact. Every day that passes, the dollars in your bank account buy less than they did the day before. The official inflation statistics do not capture the true erosion of purchasing power because those statistics are designed to understate reality. Anyone who buys groceries, pays rent, or fills their gas tank knows that prices have increased far more than official numbers suggest. Gold and silver have functioned as money for 5,000 years of human civilization. They have outlasted every fiat currency ever created. Every paper money system in history has eventually failed, returning to its intrinsic value of zero. The dollar will not be an exception to this pattern. The question is not whether the dollar will lose value. The question is how quickly that loss will accelerate and whether you will be positioned to protect yourself when it does. The institutions that control the financial system understand this reality better than anyone. They have access to information that regular people do not see. They know the true state of government finances. They know the actual inflation numbers. They know what is happening in the banking system. They know what central banks are doing behind closed doors, and they are positioning themselves accordingly. Central banks around the world have been buying gold at record rates for years. China has been accumulating gold and restricting silver exports. Russia has been building gold reserves. The BRICS nations are openly discussing alternatives to the dollar-based trading system. The smart money is moving into hard assets while telling retail investors that everything is fine. The crash on January 30th was part of this positioning battle. Institutions want to accumulate as much physical gold and silver as possible before the next phase of the dollar's decline, but they do not want to pay high prices. So they use their control of the paper market to engineer price crashes that shake out retail holders and allow them to buy at lower prices. Every time a retail investor panics and sells, that metal flows into institutional hands. Every time a retail investor gets margin called and forced to liquidate, that position gets transferred to someone with deeper pockets and a longer time horizon. Let me give you another example to understand why physical metal is so different from paper claims. Imagine there is a warehouse that stores wheat. The warehouse has 1 million bushels of actual wheat sitting in bins. Now imagine that warehouse issues paper certificates saying that the holder is entitled to wheat from the warehouse. But instead of issuing 1 million certificates for 1 million bushels, they issue 50 million certificates. On paper, 50 million people think they own wheat. In reality, there's only enough wheat for 1 million of them. As long as most certificate holders never actually try to claim their wheat, the system works. People trade certificates back and forth, and the price of certificates moves based on supply and demand for the paper, not the underlying wheat. But what happens when too many people try to claim their wheat at the same time? The warehouse cannot deliver. They have to either admit the fraud or find some way to settle in cash instead of wheat. And suddenly everyone realizes that their paper certificates were never really backed by anything. This is essentially how the paper, gold, and silver markets function. The amount of paper claims on gold and silver vastly exceeds the amount of physical metal that actually exists. Estimates suggest the ratio is somewhere between 100 to 1 and 350 to 1. For every ounce of physical silver that exists, there are hundreds of ounces of paper claims. As long as most holders of paper claims never demand physical delivery, the system continues to function. But when physical demand increases, when people start actually wanting the metal instead of the paper, the system comes under stress. That stress is what we are witnessing right now. The crash on January 30th was an attempt to relieve that stress by shaking out retail holders and reducing physical demand. But it may have backfired. The crash brought prices down to levels that created a tsunami of new buying interest. People who had been waiting for a pullback suddenly saw an opportunity. The lower prices did not reduce demand. They increased it. And now the physical shortage is even more severe than it was before the crash. Let me talk about my friend who called me in a panic during all of this because his experience illustrates exactly how retail investors get destroyed and how you can avoid the same fate. He had been watching silver rise for months. He wanted to buy, but kept waiting for a pullback. Then when silver broke above $100, he got excited. When it hit $110, he got more excited. When it hit $120, he was convinced it was going to $150 and he needed to get in immediately. He called me Thursday morning before the crash, wanting to put a large amount of money into silver right away. He was emotional, he was excited, he was scared of missing the move. And those three emotions together are the perfect recipe for a terrible decision. I told him to slow down. I explained that buying in a parabolic move when you are emotional is not investing. It is gambling. We agreed that he would cut his intended purchase in half, not because I was bearish on silver, but because discipline matters more than conviction. Then the crash happened. Silver dropped from $121 to $95 in hours. He called me again, this time in full panic mode. He wanted to sell everything. He was convinced silver was going to zero. The same person who was certain silver was going to $150 in the morning was certain it was going to zero in the afternoon. That is what emotions do to your judgment. I told him to sit tight. I told him not to catch a falling knife, but also not to panic sell at the bottom. We watched for stabilization, not the exact bottom, because nobody can consistently pick exact bottoms, just stabilization. When the speed of the drop slowed, when price started chopping sideways, when the bounces stopped making lower lows immediately, we knew the worst of the selling pressure had exhausted itself. That is when we bought. Not at the perfect bottom, but at a reasonable level after the panic had subsided. Here is the key lesson from his experience. He bought at a lower price than he would have if he had panicked into the market on Thursday morning. And he bought at a higher price than the absolute bottom. But he bought with discipline instead of emotion. He bought with a plan instead of fear. And he still has capital left to buy more if prices drop again. That is how you survive volatile markets. You do not try to be perfect. You try to be disciplined. You do not try to catch the exact bottom. You try to avoid the catastrophic mistakes that wipe people out. Now let me explain something that most people miss about buying physical metal, because this is where beginners get destroyed. There is a difference between the spot price you see on a screen and the price you actually pay. When you buy physical silver, you pay a premium above spot. That premium can be small when markets are calm, maybe 5 to 10%, but when everyone rushes to buy at the same time, premiums explode. During the panic this week, premiums on some products exceeded 60% in certain markets. Japan was paying 60% over spot. Dubai was paying 40% over spot. That means if the spot price said $95, buyers in Japan were actually paying $152 per ounce to get physical metal. My friend's break-even price is not the spot price at the moment he bought. It is the spot price plus the premium he paid. If he bought when spot was $100 but paid a 20% premium, his actual cost was $120 per ounce. He needs silver to rise above $120 just to break even, regardless of what the spot chart shows. This is why I always tell people to think in two prices, the market price and your all-in cost. When you understand this, you stop obsessing over every dollar move in the spot price and you start focusing on your true cost basis. Let me talk about the gold to silver ratio, because understanding this ratio helps you make smarter decisions about positioning. The ratio simply measures how many ounces of silver it takes to equal 1 ounce of gold in value. If gold is $5,000 and silver is $100, the ratio is 50 to 1. Historically, this ratio has varied dramatically. During the pandemic panic in 2020, the ratio spiked to around 125 to 1. That was the market screaming that it trusted gold more than silver. During the silver peak in 2011, the ratio compressed to the low 30s as silver became the crowded speculative trade. Right now, the ratio is hovering around 50 to 1, which is lower than historical averages but not at extreme levels in either direction. Here is why the ratio matters for your decision making. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. Historically, the ratio tends to mean revert over long periods. If you believe the ratio will compress, you might favor silver over gold. If you believe the ratio will expand, you might favor gold over silver. During the crash on January 30th, both metals fell, but silver fell harder. The ratio expanded. That is typical behavior during panic selling because silver is more volatile and more subject to speculative positioning. But if history is any guide, that expansion creates an opportunity for silver to outperform as the ratio compresses back toward historical norms. Now let me address what I think actually caused the crash, because the explanations you are hearing in mainstream media are mostly noise. You will hear that a big hedge fund liquidated. You will hear that a geopolitical headline spooked markets. You will hear that some economic report came in weaker than expected. All of that might be partially true, but it misses the fundamental mechanism. The crash was caused by automated trading systems reacting to the same triggers at the same time. Modern markets are dominated by algorithms. These are computer programs that make trading decisions based on predefined rules. They monitor price levels, volatility thresholds, correlation patterns, and thousands of other variables. When certain conditions are met, they execute trades automatically without human intervention. On January 30th, a trigger was pulled. Maybe it was a large sell order that moved prices. Maybe it was a volatility spike that crossed a threshold. Maybe it was simply the accumulation of conditions that made the algorithms decide to reduce risk simultaneously. Whatever the initial trigger, the result was a feedback loop. One algorithm sold, and that selling moved the price. Another algorithm read that price move as confirmation of weakness and sold too. A third algorithm had risk limits that were breached by the falling prices and was forced to liquidate. Each round of selling triggered more selling. The cascade accelerated until prices had fallen far enough to exhaust the selling pressure. The whole process happened in hours because machines operate at speeds that humans cannot match. By the time most retail investors checked their phones and saw what was happening, the worst of the crash was already over. This is important to understand because it changes how you should think about market crashes. The crash was not caused by millions of humans simultaneously deciding that gold and silver were overvalued. It was caused by machines executing programmed rules. The machines do not care what the asset is. They do not care about fundamentals. They do not care about the long-term outlook. They care only about what their models say. If the model says reduce risk, they sell everything. Gold, silver, stocks, crypto, all at the same time. That is why all asset classes fell together in a synchronized air pocket. It was not rational analysis. It was algorithmic deleveraging. A friend of mine who has traded and managed risk for decades told me something after the crash that stuck with me. He said the most dangerous thing is the story you tell yourself afterward, because if you blame the wrong cause, you will position wrong for the next move. That is exactly right. If you think the crash happened because silver is fundamentally overvalued, you might sell and miss the recovery. If you think the crash happened because some one-time event will not repeat, you might get complacent and get caught again. The truth is that the crash happened because of market structure, and that market structure has not changed. The same machines that crashed prices on Thursday are still operating today. The same feedback loops that created the cascade still exist. The same vulnerability to coordinated selling pressure remains. What has changed is positioning. A lot of weak hands have been shaken out. A lot of retail traders who were over-leveraged got margin called and forced to liquidate. A lot of emotional investors who could not stomach a 20% drawdown have sold their metal. Those positions have been transferred to stronger hands. Institutions with longer time horizons and deeper pockets now hold the metal that retail panicked out of. And when prices start rising again, there will be less selling pressure from weak hands because the weak hands have already been eliminated. Let me talk about the international dimension because there is something strange happening with silver pricing that most people do not understand. There has been a persistent gap between silver prices in major Asian trading hubs and prices in the US market. Sometimes this gap is small and can be explained by normal transaction costs and arbitrage frictions, but sometimes the gap becomes glaring. When I checked prices on January 30th, Shanghai was trading silver at a significant premium to COMEX. Tokyo was paying even more. Dubai was somewhere in between. These premiums were not small. What does this gap tell us? It tells us that physical demand in Asia is overwhelming local supply. People in Asia want silver so badly that they are willing to pay significantly more than the paper price quoted in New York. They cannot simply buy from COMEX at the quoted price and ship it to Asia because there are frictions, export restrictions, shipping delays, inventory limitations, and the simple fact that COMEX does not have enough physical metal to satisfy global demand. The premium represents the willingness of Asian buyers to pay extra for certainty of delivery. They want real metal, not paper promises, and they are willing to pay for that certainty. This creates an arbitrage opportunity in theory. If silver is cheaper in the US than in Asia, someone should be able to buy in the US and sell in Asia, capturing the spread. And indeed, metal is flowing from west to east, but the flow is limited by practical constraints. You cannot instantly ship millions of ounces across the Pacific. There are logistics, regulations, and physical limitations. The persistence of the premium tells you that demand exceeds the capacity of the system to redistribute supply. And when demand exceeds supply, prices eventually have to rise. Now let me talk about the dollar, because this is the fundamental driver behind everything happening in precious metals. The dollar is not just declining. It is declining at an accelerating rate. And most Americans do not understand this because they measure everything in dollars. If your house price goes up in dollar terms, you think you are wealthier. If your stock portfolio goes up in dollar terms, you think you are richer. But what if those gains are simply the mirror image of the dollar losing value? What if you are not getting wealthier at all, but just holding assets that maintain their value while the measuring stick shrinks? Let me give you a simple example. Imagine you have a ruler that is supposed to be 12 inches long, but every year, someone sneaks into your house and shaves a little bit off the end of the ruler. After a few years, your ruler is only 10 inches long, but the numbers still say 1 through 12. When you measure something, it looks like the thing has gotten bigger, but it has not gotten bigger. Your ruler has gotten smaller. That is what is happening with the dollar. The dollar is the ruler we use to measure value in the economy, and that ruler is shrinking every day. How do you measure this shrinkage? One way is to look at the price of things that have maintained stable value throughout history. Gold has been money for 5,000 years. An ounce of gold today buys roughly the same amount of goods and services as it did 100 years ago or 1,000 years ago. A Roman soldier was paid about 1 ounce of gold per month. Today, 1 ounce of gold at $5,000 would be a reasonable monthly wage for a soldier. The purchasing power of gold has remained remarkably stable over millennia. So when the price of gold in dollars goes from $2,000 to $5,000, what is really happening? Is gold getting more valuable, or is the dollar getting less valuable? The answer is that the dollar is collapsing in value when measured against something stable. Gold is not going up, the dollar is going down. And this process is accelerating because of the fiscal and monetary policies being pursued by the US government and the Federal Reserve. The national debt is exploding. The government is running deficits measured in trillions of dollars per year. The Federal Reserve has monetized enormous amounts of this debt by creating new dollars out of nothing. Every new dollar that is created dilutes the value of every existing dollar. This is simple math. If you have a pizza cut into 8 slices and you suddenly declare that there are now 16 slices, each slice is smaller. You have not created more pizza. You have just made each slice worth less. This is why institutions are quietly accumulating gold and silver. They understand the math. They see the trajectory. They know that the dollar is going to continue losing purchasing power because there is no political will to stop the deficits and no feasible way to repay the existing debt except through inflation. They are positioning themselves for this reality while telling retail investors that everything is fine. The crash on January 30th was part of this positioning. They want to accumulate as much metal as possible before the next phase of the dollar's decline. And they are using their control of the paper markets to shake out retail holders and buy metal at cheaper prices. Now let me give you some practical guidance, because understanding the situation is useless if you do not know how to act on it. First, understand that volatility is not your enemy if you have a plan. Volatility becomes your enemy only when you are over-leveraged, emotional, or unprepared. The crash on January 30th created opportunity for people who were positioned correctly. They had cash available to buy the dip. They did not panic sell. They took advantage of lower prices to improve their positions. If you are sitting in cash, scared to buy because prices might go lower, you need to develop a system for deploying capital over time. Do not try to pick the exact bottom. Nobody can do that consistently. Instead, divide your intended investment into portions and deploy them over time. Buy some now. Buy some if prices drop. Buy some if prices rise. This way you average into your position regardless of short-term movements. Second, understand the difference between paper claims and physical ownership. If you own an ETF that tracks the silver price, you do not own silver. You own shares in a fund that owns silver, which means you own a claim on silver held by a custodian, which means you are trusting several layers of counterparties to honor their obligations. In normal times, this probably works fine, but we are not in normal times. The physical market is showing signs of stress. Mints are suspending sales. Dealers are defaulting. Vaults are being drained. If you want to own silver as protection against systemic risk, owning paper claims defeats the purpose. The whole point of owning precious metals is to have an asset that does not depend on any counterparty's promise. Physical metal in your possession has no counterparty risk. Nobody has to honor a contract for you to maintain ownership. Third, understand that premiums matter. When you buy physical metal, you are not buying at the spot price. You are buying at the spot price plus a premium. That premium varies based on product type, market conditions, and supply availability. During calm markets, premiums are modest. During panics, premiums explode. The premium is the market's way of communicating information about supply and demand for physical metal. If premiums are rising while spot price is falling, that tells you physical demand is strong, even though the paper market is weak. Pay attention to premiums. They often tell you more than the spot price. Fourth, have a plan for both scenarios. What if prices go higher? What if prices go lower? If you only have a plan for one scenario, you will be paralyzed when the other scenario occurs. Write down your plan, decide in advance what you will do at various price levels. When you are emotional, you will make bad decisions. Having a pre-committed plan removes emotion from the equation. You simply execute the plan you decided on when you were calm and rational. Fifth, do not chase parabolic moves. When prices are rising rapidly and everyone is euphoric, that is the worst time to buy. The best time to buy is when prices have crashed, panic is everywhere, and everyone is convinced that prices are going lower. That is exactly the opposite of what your emotions want you to do. Your emotions want to buy when prices are rising and sell when prices are falling. Successful investing requires doing the opposite. Buy fear, sell euphoria. Easier said than done, but that is why having a plan matters. Now let me address the question I have been getting constantly since the crash. Is the bull market over? Is this the top? Should I sell everything? My answer is no, this is not the top. The structural forces driving precious metals higher have not changed. The dollar is still being debased, the debt is still exploding, central banks are still buying gold, China is still restricting silver exports, physical demand is still overwhelming supply. None of that changed because prices crashed on January 30th. What changed is sentiment. What changed is positioning. What changed is that weak hands have been shaken out and strong hands have accumulated. Bull markets do not end with crashes that occur while physical supply is vanishing. Bull markets end when supply is abundant and nobody wants to buy. That is the opposite of what is happening right now. Everyone wants to buy. Nobody can get supply. The crash lowered prices temporarily, but it did not change the fundamental imbalance between paper supply and physical demand. If anything, the crash made that imbalance worse by creating a wave of new buying interest at lower prices. Let me tell you what I think happens next. In the short term, there will be continued volatility. The forces that created the crash on January 30th are still present. The algorithms are still running. The feedback loops still exist. We could see more crashes. We could see rapid recoveries. The day-to-day and week-to-week movements will be unpredictable and violent. Do not try to trade this volatility unless you are a professional with risk management systems in place. For most people, trying to trade volatility is a fast way to lose money. In the medium term, I expect prices to recover and eventually exceed the highs set before the crash. The fundamental drivers are too strong. Physical demand is too robust. The dollar decline is too persistent. Once the shock of the crash fades and weak hands have been fully eliminated, buying pressure will reassert itself and prices will resume their upward trend. This might take weeks or months. I do not know the exact timing, but I am confident in the direction. In the long term, I expect precious metals to substantially outperform most other asset classes as the dollar continues its decline. This is not a prediction about specific prices, it is a prediction about relative performance. Whatever you think gold and silver are worth in dollar terms, I expect those numbers to be significantly higher in 5 years than they are today. Not because gold and silver are becoming more valuable in real terms, but because the dollar is becoming less valuable. Gold and silver will maintain their purchasing power while the dollar loses it. That is what they have done throughout history, and that is what they will continue to do. The crash on January 30th was painful for many people. Some investors got wiped out, some lost their positions, some sold at the exact bottom and handed their metal to institutions at the worst possible price. But for investors who understood what was happening, who had plans in place, who maintained discipline and avoided emotional decisions, the crash was an opportunity. It was a chance to buy at lower prices. It was a chance to improve positions. It was a chance to accumulate more metal before the next leg higher. I want to leave you with one final thought. The battle for positioning in gold and silver is intensifying because the stakes are getting higher. As the dollar continues to decline, as physical supply continues to tighten, as institutional demand continues to grow, the competition for available metal will become more intense. Crashes like January 30th are part of this battle. They are tools used by institutions to shake out retail holders and accumulate metal at lower prices. If you understand this, you can position yourself on the right side of the battle. If you do not understand this, you will be the victim of it. Choose your side wisely. The dollar is losing value every day. Precious metals are becoming scarcer every day. The institutions controlling the paper markets are accumulating physical metal every day. The only question is whether you will position yourself alongside them or allow yourself to be shaken out and left behind. The crash on January 30th was designed to make you sell. Do not give them what they want. Understand the game, maintain discipline, hold your mettle, and prepare for the next leg higher because it is coming whether you are ready for it or not. This is William Lee. I will continue to bring you updates as this situation develops. The story is far from over. In fact, I believe we are just entering the most important phase of this precious metals bull market. The phase where the disconnect between paper prices and physical reality becomes impossible to ignore. The phase where retail investors who understand the game accumulate generational wealth, while those who do not understand get left behind. Make sure you are on the right side of that divide. Everything depends on it.